It's getting a bit much, isn't it? I mean, this rhetoric just gets, well, louder.
Absolutely. And again, of course, a lot of it has to do with, what U.S. agenda is trying to push China in terms of kind of changing the trade negotiation platform, pushing them to open up a little bit more and give some concessions. And I think as long as the U.S. equity markets do not react very violently, as long as Trump's ratings continue to do well, going into midterm election, this rhetoric, unfortunately, can continue.
This is just it. I mean, so we've got a long way to go because that's November we're talking about.
Yes.
But, do you see any signs of there being a détente here?
Well, the fact that we've had a bit of a waiver on ZTE kind of shows you a little bit of softening of stance. The fact that U.S. is now, kind of moving away from kind of punitive investment restrictions on China, and then kind of going through the CFIUS bill is a little bit softer. Let's see. I mean, of course, it's $200 billion goods that are being subject to 10% tariff. The negotiation process is quite long. We still have consultation and final hearings at the end of August. So any potential timetable for implementation at the earliest could be September. And note that the U.S. can actually delay implementation of tariff for another 180 days. So I think this is where the window of opportunity for negotiation is going to happen.
It started off with just 18 products the tariffs are slapped on. Now we're talking over 10,000 of them. It's quite incredible.
Yes, I mean, obviously, that's sort of the negotiation style at the moment. Initially, it was all about targeting some of the goods that are related to Made in 2025 program, but clearly, this last round of $200 billion goods, they are going to hit some consumer goods. So it's 40% about capital goods and about 30% consumer goods. And I think where there's going to be potential room for negotiation is, I think, even within U.S. interests, there's going to be some pushback and heavy lobbying from corporate interests, from retailers, et cetera. So I think this is where hopefully there is a window of opportunity. At the moment, our base case is the $50 billion of goods to be subject to two
Well, we've got possibly $200 billion we're talking
about. I think at the moment, our base case at the moment is that $200 billion the tariffs will actually not push through. Of course, in the interim period, there'll be a lot of uncertainty, and that in itself could hold back economic activity.
I just want to throw this chart because it could actually turn even dirtier with the fact that this chart tells us effectively that, well, they just don't import enough from the US to match the tariffs. I mean, that's the base case when we've been talking about this for a long time. So they have to do something else, as you say, they can make life difficult for American companies, and that's the problem. And that could really then upset the apple cart even further, if you can upset it further.
Well, I think China obviously is trying to balance the fact that they need to kind of show a stronger kind of counter response, but at the same time, they do not want to escalate. Now, there's a number of things China can do. One is you don't have to, obviously, they only import $155 billion of goods from the U.S. last year, so you can't really target more goods, but you can target more tariffs on the existing goods. So that's another way you can kind of make it kind of proportional. They can go after services, as you mentioned, they can go after regulations and companies. But China has to kind of be very cautious as well, because if they go very punitively, it can also boomerang effect on them in terms of their domestic economy.
Joanna, we just got the